Good day to everyone present here. Today, in this video, we are going to learn about dividend policy and the types of dividend policy as a part of financial management. Before we move on to the types of dividend policy, let us understand what do you mean by dividend policy of an organization. As we know that one of the major activity of a finance manager is to perform three major decisions like financing decision, investment decision, and dividend distribution decision. Once an organization starts raising capital through various sources and by analyzing its cost that is involved and investing these borrowed amounts into various long-term and short-term capital, once the company starts gaining returns, the next immediate job that a company or an organization does is to distribute these profits that these organizations have earned to its shareholders. So when you talk about dividend policy of an organization, we here are going to talk about how much of profit is to be retained within an organization from the profits that an organization has earned, and how much of profits is being distributed among the shareholders as dividend. So the decision that an organization takes in order to retain the profits aside without distributing it as dividends is known as retained earnings, and the amount of profit that is being distributed among different shareholders according to the proportion of their investment is called as dividend policy decisions. Now, whenever an organization pays dividends to its shareholders, it depends upon the discretion of the management and how much of profit has to be distributed, because these managements are responsible to decide on how much of capital is required for the future needs or the future use of the organization. So any decision pertaining to how much of profit has to be distributed to the shareholders out of the profit that each organization receives on a yearly basis is called as dividend policy decisions. Now, as we have understood the basic outline on what do you mean by dividend policy, moving on, we will understand what are the types of dividend policies that normally an organization follows. Now, according to financial management, there are four types of dividend policy that an organization can have. One is called regular dividend policy. Secondly, we have stable dividend policies. Thirdly, we have irregular dividend policies. And lastly, we have no dividend policy. Now, let us together see what all these types of dividend policies mean. Regular dividend policy. Any company that pays a fixed percentage of profit as dividends on a yearly basis to its shareholders is called as regular dividend policy. Now, let us be clear on what do you mean by fixing a percentage on the profit. For example, let's say ABB Limited has got a profit of 1 lakh rupees during a given period of time. And if the regular dividend policy that the company follows is, let's say, 10%, that means out of 1 lakh of profit that the company receives, 10% of 10% of the profit that is being received will be paid as dividend, which is 10,000. So similarly, if the organization receives 2 lakh as profits, the amount of profit can fluctuate, but not the percentage of dividend that is to be paid to the shareholders. So such kind of policy that is being followed by an organization where they fix the percentage of dividend to be paid, which fluctuates depending upon the profit earned, is called as regular dividend policy. Now, companies with a very high profit motive or which has a long standing in the market will be able to pay the shareholders a regular dividend policy. So hope in the example it is clear that regular dividend policy is a scenario where company tries to fix a percentage of profit as dividends to the people or to the shareholders, and not the amount of profit. So the amount that is to be paid as dividends depends upon the profit that the company earns. If the profit of the company is less, the percentage would be still 10%. If the profit of the company is high, the percentage still would be 10%. So here, under regular dividend policy, the company is trying to fix a fixed amount, fixed percentage of profit as dividends and not the amount to be paid as dividends. So this is known as regular dividend policy. The second type of dividend policy is called stable dividend policy. Under stable dividend policy, the companies always fix a certain amount to be paid as dividend to its shareholders, whatever may be the profit or loss incurred by an organization. So even if the profit of the company is very high, let's say for example, the profit of the company is 1 crore, the amount of dividend that you pay per shareholder will remain as rupees 10, for example. Yeah. Similarly, if the profit of the company is less, let's say the profit is only 1 lakh, even then the amount of dividend paid by the company to its shareholders remains as rupees 10. So under stable dividend policy, the company is able to follow such policy because the company has a long standing in the market. It has a good reputation. It has a better goodwill, and the company is known for paying dividends to even to the equity shareholders on a continuous basis. So only such companies follow stable dividend policy. In simple, in the share market, companies known as blue chip companies are able to pay stable dividend policy, whatever may be the profit or loss of an organization. So even if the company incurs a loss, the amount of dividend does not change. The amount of dividend remains fixed, as in the example that I've told you. That is, even if the profit is 1 crore or 1000 crores or whatever is the profit, the company pays rupees 10 as dividend per share. Or if the company has got a profit of only, let's say 50,000, or company has a loss, even then the company pays a dividend of rupees 10 to its shareholders. So such kind of policy is called as a stable dividend policy. And remember that such dividend policy can be followed by only blue chip companies which have a well reputation and goodwill in the market. The third type of dividend policy is called as irregular dividend policy. So with an irregular dividend policy, there is no hard and fast rule that the company has to pay dividends regularly to its shareholders. As equity shareholders, they are pretty much aware that they are leased to get dividends. So there's essentially no set schedule that the company has to pay dividends to the shareholders. That means that the company's board of directors will decide on how much of profit is incurred by the company and how much should be paid as dividend, whether to pay dividends or not. All these dividends will be taken only by the board of directors of the company. But the dividend which is not paid by the board of directors to the shareholders must be reutilized by these directors or the management of the company for the betterment or for the welfare of the company, or let's say for expansion of the company. So under irregular dividend policy, the company has no obligation to pay dividends to its shareholders, wherein it depends upon the board of directors whether to pay the profits as dividends or to retain the entire profits for future expansion and growth of the business. So the last type of dividend policy is called no dividend policy. So under no dividend policy, a company retains all its profits and does not pay dividends to its shareholders at all for a certain period of time. The chief or the major reason for such kind of policy to be followed by an organization may be because of financial constraint, or the other reason may be the company would be a new company or a fresh company that has been introduced into the market and is gaining importance, and therefore it wants to expand its business operations. Now, because dividends are not issued to the shareholders, it doesn't mean the reputation of the company becomes less, because the shareholders are pretty much sure in the share. They're called for a shareholders meeting and they're well informed that the dividends will not be paid for a stipulated period of time, wherein all the dividends that is to be paid to them will be reinvested in the company for further expansion. Or in other case, the companies do raise shares at a lesser price than its face value, so that in the share market, when the price of the company picks up, they could sell it at a higher price and take the profit out. So this is known as no dividend policy. So by this we have covered what is dividend policy and the types of dividend policy. Just to have a quick recap, we have seen 4 types of dividend policies, namely regular dividend policy, stable dividend policy, irregular dividend policy, and no dividend policy. Thank you. Have a nice day.